Hey everyone, my name's Andy from the Finding Value Finance. Today I'll be your host. I've got with us Patrick Karim from NorthstarBadcharts or Badcharts1 on Twitter. Wanted to get him on. I was looking at his Twitter. He's posting just a bunch of ridiculously good looking charts that I've seen. I wanted to bring him on. I was like, man, this looks good to go. He's got lots of lines that are being broken to the upside, especially I think in gold and silver, a lot of ratio charts. Things are just looking crazy at the moment. So Patrick, thanks for coming on. I really appreciate it. And
Yeah.
what are you seeing out there?
All right. Well, thanks for having me on, Andy. I always love catching up with you, and I'll show your. Let me just share my screen. I'll show your viewers some charts I've been working on that I haven't posted anywhere. So we could start with the Russell. So okay, fine. I'm picking on the weakest of the U.S. equities, but I'm trying. Let me grab some see some hope. And I have the AZA. AZA is the gold and silver precious metals fund. So it's like JDX and all that, but people are looking at JDX, but we don't have data going that far. The AZA, I have data going back to, well, the Russell stops at 1988 there, but the AZA goes back all the way to the late 60s. So, but the takeaway is this, I'll just zoom in here, is Russell outperforming the AZA. So when that happens, well, you're in US equities, right? Everything's going good. So this is the bull run from 88. And after that, in 95, we had that scare for US equities. But then it just decided that was the melt up. Losing momentum, breakdown below the 1 year and 3 year, and down she goes. So when the Russell breaks down versus gold and silver miners, never mind gold there, the big kahuna, the big asset class leaders, we know that was a bull era that started for the miners and all that. And here they tried to rally back in 2005. The Russell cannot outperform. The gold and silver miners were doing pretty good until what? Well, the peak in gold, 2011. And that was the time to flip, guys. Bullish cross, went in 3 year, out of the cloud, retest. Well, of course, we'll go long again, once again, US equities whenever it's time to go. But right now, that's how you play these setups, guys. So I'll just zoom to today. Here broke down, but here was a pretty acute rising trend line. So that the more acute it is, there's always some type, the downwards momentum is not quite killed yet, but it was the first slowdown in 2016. And that was the crazy rally we had in gold, silver miners, right? Everything went bonkers in the late 2015 to 2016. That was just like a bear market rally. So now US equities are fine. They go back up, back above the 1 year, but back above. But that low here created it created the new trend line, which is less steep. And now it broke down, guess when? In June of 2019. And that was when gold actually broke out on its own chart. So the AZA, the miners are awful, terrible miners, as terrible as they are. We're starting to say, okay, Russell, you cannot outperform me anymore. You've done what you had to do, and then it went down. We had that crazy rally from 2019 all the way to the blow off top in the precious metals. Well, in 2020 when they started going sideways, a reflation for the U.S. equities. But look at that, guys. It did not surpass its 2018 peak. So right now, I don't know what you want to call this. Maybe a head and shoulders. I'm not a big fan of calling those out, but here, this rally poked above, but right now 1, 2, it's closing. I'll put it on the line chart to remove noise. It's not looking good now for the Russell is not able to outperform the miners once again. So this is very, very, very positive for the precious metals fund, for the precious metal sector, if they're able to outperform the Russell capital flows. So if this breaks down, we'll have a rush in precious metals. And I don't know, maybe there'll be a bounce once we get down here. There'll be some type of recovery in US equities, or US equities will start outperforming, or maybe it'll be a correction. US equities could go flat, right? It's a ratio, but the precious metals fund could correct. And then after that, we have this is the play. Whatever we're living now, no matter how much adrenaline you guys get now, it's nothing compared to this move here, because this is what I call a reverse symmetry move. These moves, I'll just put the thick angled 71%, 71 degrees. That's how fast and how long it's going to play out, guys. So pretty aggressive outperformance of precious metals with miners, gold and silver miners. So this is pay dirt. This is adrenaline, but this is steepness for lots of steepness for a long period of time. And that's probably our end game. At least one of our, that's probably like, it's going to be crazy here, man. This is insane. Your YouTube channel is going to have over 1 million followers. It's going to be crazy stuff, man, when this happens.
Well, that's a payday for all of us.
Well, hopefully,
if we can hold through it.
Yes, well, exactly. Yeah. So people are going to have different techniques to whatever to, stretch from moving average, take profits and all that. But the takeaway is there's a shift from the Russell. So from US equities, their small caps, and a lot of that capital flows is also going into NASDAQ and all that, right? The capital flows leaving those small companies in the US, going to the big tech, and some going to miners. But eventually this is going to be, this is how you want to play it. I'll just overlay you guys the as a chart on it just to show you why it is really the new on a new price scale.
Do you think that ratio can drop even if both assets go up? Or do you think you're actually going to have one go down and one go up? Or is this going to be like a massive inflationary period? What I mean, I know it's just an opinion, and obviously we're looking at the charts and seeing what's going to outperform, but what's your opinions around that?
Well, okay, I'll put the SPX. This is a thing. So when the SPX breaks down versus gold versus produced price index and all that, it's just the odds are that, am I on log scale? Yeah. The odds are that it will nominally not go as high as people think. So people saying, oh, the destruction of purchasing power, Bitcoin's pricing it in, there's inflation, so we're in hyperinflation, everything goes up. It might not go as high as people think. So I thought about that. I said maybe the rallies are going to be maybe a little stronger, maybe like the 60s. I'll show you the late 60s, what it did nominally SPX, even if it broke down versus produced price index and gold back in the late 70s. It did nominal rallies that did new highs. I'll show you here. So here is the late 60s for the, here is a massive trend line. So even if it broke down, look at that. This could be happening, Andy, to US equities. So the SPX here had broken down versus gold or produced price index back in the late 60s, but nominally, when it rallied, even if that ratio of gold to SPX kept plummeting because gold outperformed, silver outperformed SPX. Look, SPX, it did a nominal new high. A lot of people don't mention that. And I guess maybe if we're in a similar type of inflation type of a lot of inflation, it's possible that this traps everybody, right? Everybody will get trapped here. Imagine if SPX does a new high right now, right? Let's see, what is that going to look like?
It's going to suck everybody in.
Probably going to do new high.
It's the bull trap.
Yes, this could happen. This could definitely happen. I'm not. This is the thing. I don't need SPX at this stage. I don't need SPX to go down 80% for precious metals to go up. It's done. Because just look at the SPX to gold or SPX to or NASDAQ to silver. That's all I need to know. So this is actually very bullish for precious metals. If they print so much money to nominally get the SPX up that high in an inflationary cycle, the precious metals are gonna outperform that so much more. Like, yes, exactly. So this is definitely that's gonna possible.
Because they're gonna get like a scare, and then they're just gonna pump the system again. And then it just gets everything to one last high or something, and
yes,
and gold's
more than they did. Yes, more than they did in the 2000s. So we're gonna go in the 1972 type of scenario where it really melts up. But after that, if you take and this is the trap. I could just play NASDAQ. I could just play SPX, my IRA, blah blah blah. Well, unless you have dividends, and every year you reinvest those dividends and try to offset that, and this is not adjusted for inflation. You still, even if you went up high, unless you're a good trader for what, 68 to 1980, it's like what, 12 years? And even here you had a hard retest. 20 years you went sideways while you could have been in this beast called silver.
Yeah, silver.
You could have been in this thing. So this is what I'm trying to wake up people to is Now you have to look at racial charts. And I know you're a big fan of racial charts.
Love them.
Look at racial charts, guys. Look here. You see how it reflated? Silver dropped a little bit, but look, even here when it went to all-time high, silver says, this is, you're doing monetary imbalances to keep those SPX afloat. And silver just went bonkers. And even while US equities crashed hard, silver barely went down. You know, often, deflation, US equities go down, and people say silver has to go back to $5 or $10. Well, it didn't do that in the 70s, guys. It did not, silver did not go back, retrace all to the bottom. It just held its ground. And then after that, it went bonkers. Here again, US equities, hard pullback. Silver just said, sorry about the language. Silver said, I'm going my own way. So there's a lot of stuff we could learn from the 70s.
I think I think we could have an everything rally or something at some point here shortly.
Yeah.
Like look, you just showed there. Yeah.
People just got to look at, there's going to be some sectors going to be terrible. So if you want to really play the SPX instead of just going long the SPX, well, at least look at the 12, there's 11 or 12 sectors in the SPX. Go long the ones that are outperforming the other ones, because maybe the financials will not do this, right? Financials might stop here. There might be some more, like, what's the financial one? KRB? The banks? No, it's, what are the financial? I can't
remember the financial.
XLF.
XLF, yeah, that's what it is.
What is that looking like? So let's see. XLF. Well, it's not terrible. Let's see that thing. Yeah, well, here's its highs. The idea is, look, yeah, even here in 2007, they did a high above their 2001 peak. The financials, look at that thing. They went bonkers here. So it's not, forget the doomsayers, forget the guys who say everything has to go to zero, everything has to melt up. Even these melt up guys, they're kind of, it's all clickbait stuff, because now you have to look at ratios and you just want to be in the asset that outperforms. Reduce, stop trying to catch whatever, melt up or it's going to go down. That's going to trap you. Look at the ratios. Here's another one, SPX to sugar. Sugar, I have a lot of data. So yes, sugar's been going bonkers for a while now, and it tracks the rate of change of gold. It tracks the rate of change, and it just loves. I could do that chart after. So here's SPX. I have sugar futures for early 70s. When SPX broke down versus sugar, we know what happens here, right? To silver, it just goes bonker. I'll just keep the sugar chart here. Here, I'll put in log scale. So as SPX breaks down versus sugar and cannot make a new high, that whole entire region, zone, that 10-year period, gold, silver, all the stuff we're looking at right now, they went up. Here, and as SPX breaks out versus sugar, I don't like that line. Here, I'll put just angle back thick. And as SPX breaks off of sugar, then that was the end. Here again, breaks off as a sugar, back test. Here was the 1994 breakout, probably. Yeah, 1995 breakout for SPX with sugar, blow off top. And look what's happening here. This is clear momentum breakdown, pretty much the same that we had even in 2002. SPX breaks down, retests. So that could be our rally, right? Where SPX reflates. But now, man, look at this. This is ugly. This is a massive rolling over type of top, kind of a dome. Let me put, it's like almost a perfect dome. This is just nice. Terrible. Yeah, it's perfect. It's like perfect dome. And it's losing. It lost a 12-month moving average. It lost a 3-year moving average. It lost that raising trend line. Now we're going to get a def cross soon. Yes, of course, it might be a pullback. It lost lost this breakdown line. Now here's the next one. If it closes a month here, it's about to lose another one. It's like, Jesus, like every time this has happened, it's been a bull era for silver and gold and miners, uranium, oil, you name it. It's like, this is massive. Nobody's looking at that. I don't know who's shown you SPX to sugar chart. It's like we talked before, you want to weigh the evidence. You have a scale. Okay, you want to say I'm unbiased. I have growth stocks, SPX, or I have commodities. And then you start looking at charts. Okay, SPX breaking down versus sugar. So that goes into commodity. oh, SPX breaking down versus gold, tuck, tuck, tuck. And eventually, well, okay, well, there's the evidence. And until SPX starts winning again versus all these commodities, and until the scales tip over back in favor of SPX, that's how you should allocate, not financial advice, but that's how you should allocate your portfolio. Is you want to go in the best outperforming asset classes. And right now, sugar is just like, it's
Killing it.
like, I don't know, it's just
Killing
bonkers.
it.
It's been bonkers for a while. So that's a good for me, leading indicator. As long as SPX cannot break out versus sugar, it's all good, guys.
What do you use any like inverted yields or anything with yields to give you any indicators at all?
Yes. So I did the, it's funny because I was working on the US oil versus the, what was that again? Inflation. I was dividing the US oil. Yeah, I was having fun with that. So this is oil divided, I'll just remove my indicators. So I had oil versus inflation. And then what you could do is, I'll put that on the monthly. And then I did the 30-year. 30-year. Oh no, it's what? TNX, TYX, TYX.
TYX.
Divided by TNX. And it's practically
it's a gold chart.
It's practically the same chart. So
yeah.
It's kind of weird. So that's how sometimes I do I say like chart defined macroeconomics. Well, instead of me having a thesis and trying to fit on the charts, I just look at the charts, see the correlations between those major asset classes, and then I could have some type of thesis. So for me, US oil is, because I've always, like, I'll show you the US oil overlaid with inflation rate. US oil. And then I'll just pop over, remove all indicators. I'll pop up the inflation rate, new price scale. And I'll reset chart. You'll see that essentially inflation is oil.
Yep.
There's not much like it, that's what it is, right? So I don't even care about the CPI numbers. If I see oil putting in a crazy back test of a critical breakout line with a wick below it and starting to move up, I don't care about CPI. Like, market doesn't care about CPI. Market's looking at this, man. That's what's impacting everything. Like, CPI is noise for people who want hindsight news and actions. Like, it's like I know where CPI is going when I see the oil chart when the oil chart doing that, right? So if I go back to this one, so US, when I see that and those charts similar, so US oil for me is like the 30-year yield, and then the inflation rate is like the 10-year yield. Did I get that right? Or inverse? TNX is the 10-year yield.
Yeah, TNX
so
is the 10.
Oil is pricing in further away inflation. Look at that thing. It's beastly. But the takeaway is, when oil outperforms shorter term inflation, even if those charts look practically alike, right? Gold bottoms and rockets, silver bottoms and rockets. Most recently on these turns, I could overlay. I'll just hide that. I'll just put the 30-year divided by new price scale. And the bottoms in gold, where was that when the 30 years, the longer term inflation rates start outpacing the shorter term, those were critical bottoms for gold. There, here, turns up. Gold does its 2015 to 2016 rally. Right here, crazy bottom in that, the 30 divided by the 10. And here again, it's starting to move up.
Yep.
Crazy stuff, man. Everything's aligned. The gold chart's just bonkers. The SPX to gold, and that XAU USD SPX. If I put it on the, I'll go crazy. I'll go on the yearly. I know people are not going to wait for their yearly, but where is, okay, this one, hide that one, hide, reset chart. Look at this. This is the biggest yearly defined base here. This wick here, that was a 2020 rally. It created a huge wick where gold was outperforming SPX, but by the end of the year, you kind of say, well, it was a bear market rally. It was like a kind of a bull trap in favor of gold, the 2020 peak. Because look where it closed. That's 0.51. So about half, when gold is worth half of SPX. 1 year, 2, 3, 4, 5, 6, 7 years, gold has never been able to close above the halfway mark versus SPX. The last time it had that huge a base was back in the 60s. 1, 2, 3, 4, 5. It had 8 years that it was basing below that line. Here was the blow off top in US equity, so it created more of a V-shaped type of recovery, right? Because it was so exaggerated. It V-shaped, stalled, and then after that it moved up. So now we have a hybrid. We have a 1970s, 60s type of bottom versus US equities, plus a higher low. It's bonkers. It's like, I keep saying that word, but the setup is just so epic. If ever we get a yearly close above that 0.50 convincing, it's like, it doesn't do that and come back down. You're going to get huge candles of outperformance of gold and silver versus SPX if it's ever able to get a close off a turn. Look at these turns, these yearly defined turns. Here's the 1931. These yearly defined turns, once you do that, it's you don't turn back.
Big
the
moves.
Market, yes, huge moves. Here, see that candle close above that. Here, that candle close above that the red one. These are reversal candles when you get a close above the open of the previous red candle going down. Here, look, if that happens, there's no turning back. So if you don't want to wait for the end of the year, I could go on the 6 month.
So you've got 3 potential outcomes based off of gold versus the S&P 500. I see I think those are potential price projections given where that ratio or relationship goes.
Yes, because I know that gold will peak when SPX is back at its nominal highs or pretty close, or just where it started breaking down at the beginning of the bear market for the US equities. Like we saw the first chart, the 1968, 70, or the 2001, 2, when it's really started falling over. And like you said, the US equities can go up with gold and silver, but gold, once SPX is able to overtake gold for good, and that ratio of gold versus SPX starts winding down, SPX will probably be at its previous all-time highs, probably having morphed into existence, two previous touches, and its own breakout. It will break out, and a breakout in US equities on its nominal chart, like a real breakout, not just a bear market trap. A bear market trap where it just peaks above, like a solid valid trend line with multiple touches. Once it breaks out above that, then yes, capital flows have left precious metals in favor of SPX. So if I do that, if I know that here we're about at 4,000 SPX when gold will peak, SPX will be around 4,000, 4,100. Just take the ratio 5 times 4,000, and then that's my gold target here. 2.8 or 3 times 4,000 SPX at the end of the bull when gold peaks. It'll be 12K and 8K here. That's just based on every single time that gold has peaked in its previous cycles. SPX was always at its nominal highs when it started going down. I don't know why people don't see that. People always think that the SPX has to be rock bottom for gold to peak. It's never been like that. Never.
Yeah.
Gold prices in the destruction of purchasing power required to lift the SPX afloat. It's always been the name of the game. I could show you one more chart. And this is the US purchasing power. This is the bonkers one, bonkers reset chart. Yeah, that thing's just melting. I'll put it on the 4-year rate of change. So essentially, this is the US purchasing power since 1913. Here, the 4-year rate of change, it starts to go back up. The red line, above the red line, you're in positive rate of change, 4-year rate of change. So here, if this line goes up, that's actually your purchasing power going up. So your dollar is able to buy you more. Since 1941, or since the close, since 1936, you've never had positive 4-year rate of change on your US dollar. It's been going, and you see in the top chart, it's been practically going downhill forever, right? And here it tried to rally in 56. It tried to go positive, the 4-year rate of change, but they said, screw that. We're going to depreciate your US dollar to finance wars. I think Korean War, a whole bunch of wars, stuff happening. Here it breaks down, 1960s. Here, huge bull market for precious metals here during the whole 70s, until the rate of change is so deep that it goes back the other way. And here we came so close a few times going positive. Well, so close. That's the closest we ever got. And look how it's breaking down now.
Yeah, it looks like garbage now. Well, great
now
for precious metals.
Yes, and here it just
And
did a bear
commodities.
flag that broke down like bad. So it just did another. I'll put a horizontal line. All these horizontal support lines are just melting through. So maybe here a bounce, but look, this is a bull era in precious metals, and I'll just overlay gold because gold we know tracks this inversely. So I'll flip the gold chart just to show you guys inversely how it tracks that. And that's essentially the gold prices in the rate of change of the destruction of your purchasing power. So it's not looking good until this thing bottoms to some crazy level here. There's a lot of fuel left. Oh my goodness, even here, there's a lot of fuel left in the reservoir of destruction of purchasing power before people bring out the pitchforks, before inflation just heals itself, right? High prices for long periods of time, supply comes online, until all that stuff auto heals itself. Because I don't think no matter what the Fed does or anybody does, they're just trying to fix the symptoms. It just takes time. This stuff is going to auto heal to a certain extent via time. This is the fuel for the precious metals era, guys. This is it.
Here's another question for you. I know in the mid 2000s, we had that last bull market in precious metals. The purchasing power didn't really go down here. Do you think this next move coming up in gold and silver is much more like the 70s in terms of the size of it than even the mid 2000s?
Yes, because right now the 2000s, and it's more the purchasing power is more impacted by the oil chart. So here is the breakdown in the slowdown momentum in the 99, and here was 2008. So here that was uranium, all the energy stuff pretty much peaked, because we know oil did another rally after the 2008 like deflation type event. So this oil, all that stuff, even copper, they didn't really put new highs in 2011. Only gold and silver went bonkers in the later stage. But what that actually did, it created this trend line 1, 2, and then we had just a small touch. So yes, it's a much bigger move right now, because now the angle, see how if we relate the steepness of an angle, we break down, there's still upwards momentum, because see here, it still went up. Sometimes it always tries to back test higher, right? It tries to re-grab on, but now this is getting to be less and less steep. And once you have these less and less steep type of breakdowns, there's no turning back. It's like whatever was helping you go up, it's evaporated. You're running on fumes, and then
Crash.
It changed my mic on. Yeah.
It's still on.
Yeah, it just crashes. It's just like, okay, I'm tired. I can't run uphill anymore. I give up, and everything else just goes bonkers.
This one's the rate. It says the rate of change, right? Or we're pricing
it's a rate of change, and the other one's just a moving average I put on top of it.
So the rate of change is crashing. Okay.
Yes, the rate of change is definitely crashing, and you have to look at that, because if you look at a line like that, there's no clues. People put all these charts. I love these people putting on these Fed Fred charts, and they're not doing TA on it. They're just putting a chart and then putting a clickbait type of title or something saying, "Oh, look, it's just bottom left to top right." And you could barely see changes. So what gold, silver, instruments, the whole market reacts to changes, right? To breakdowns, oil, like they price that in, because if you're just looking at that chart, there's nothing to see here. It's been going down, but we know even if purchasing power has been going down forever, we know that there was a huge bear market for oil, gold, and all that during the 80s. We know that it's been that, and there's been a bear market since 2013 all the way to 2020. But the rate of change tells you the truth and all of that, right? So this is what you play, guys. This is how you know, or you add probabilities of those possible moves in those instruments. Look, the tip. The gold broke out versus the treasury inflation protected. I don't know what use they had, these inflation protected treasuries. Who's buying that? Might as well buy gold, because gold divided by tips, gold has been demolishing those inflation treasury protected instrument, the tips. Why the hell would you buy tips when gold has just been demolishing it since even 2015? Like, gold is the best purchasing power protector ever. It's like, it's not just gold tracks it. It's not speculation, and it's been breaking out. And every time it broke out versus the tips, well, it's because gold price is going bonkers. Look at that. Even here, the 4-year rate of change going up. So we're far off from a blow off top, and gold outperforming the tips. Like, it still has some room
to run. Yeah.
Even here, look, here was the last chance that 2022 there was time to go long gold versus the tips.
You know, when you look at all these different charts and you're looking at all these different assets, and you look forward 18 months, 2 years or whatever, how would you sum up what you're seeing in all these charts? And what asset classes are you just like, man, this looks really, really good over the next 2 years, 3 years or whatnot?
Well, right now it's the precious metals, the miners. It's like their time to shine. The gold to SPX ratio, uranium had its flare up. So this was the order that it happened. 2019, gold broke out. Then silver and the miners out of that March low. Then in December, uranium went bonkers. Oil went bonkers in 2021. And then those high energy costs, then they stopped, they halted the US equities, their P&Es, whatever, their margins, everything, and then everything crumbled, right? So I think we're back, we're recycling again. Now it's like the miners, they've been totally destroyed. The gold to SPX ratio looks great. And I know that I could overlay practically any miner on top of the gold to SPX ratio, and they track that. So if gold to SPX breaks out, then the miners are just going to suck that up. Yeah, you see that as a chart. Did we do the as a chart versus the Russell? Yeah, we did that. So the miners now are outperforming.
Looks good.
And as soon as they finish, probably done their melt up, uranium's probably gonna be its turn to kick in. Oil isn't looking not that bad, man. Oil might be moving at the same time as those gold and silver charts, because you saw that oil chart, XOPs, that they've retraced hard. People think it's deflation. I don't know what they're smoking, but they're not looking at the charts I'm looking at. It's just a hard back test, and the same back test that it did, oil did the same back test back in 99 to 2001 when US equities started running over. It did the same crazy 30 or 40% back test of a huge breakout line. You got to trust those huge bases. Oil, you saw that huge paradigm shift breakout line. You got to trust that. The yields are going up, and they're just back testing breakout lines. It's like, I don't know, man. People can't see the big picture. It's maybe they are. I don't know. But yeah, so gold, silver, the miners, and oil, like, yeah, oil is just correcting right now. And some oil stocks some of the oil stocks have never pulled back that much, and they're about to recontinue their bull flags, like Meg or whatever. They barely corrected, and they're ready for another leg up. It's like, yeah, beautiful setups. People are probably going to wait until we're too stretched from those moving averages. They'll start piling in, but it's not going to be time.
And so when you get bullish on like gold and silver and the precious metals and whatnot, do you have any opinions on the timing of, say, like royalty companies, the regular gold and silver mining companies, and then maybe the explorers? Do you think it's the time to get into explorers, or is that something that's just like, it's not ready yet? We need that reflation to come back in the system where it goes crazy. Do you have any timing on just kind of those overall big picture kind of sectors or groups in the gold and silver, because I'm bullish gold and silver as well. I tend to stick to the bigger stuff, avoid the explorers. It seems like the explorers is a wasteland to some extent.
Well,
But what's your
yeah.
opinions on that?
Yeah, look, the explorers, they're clickbait. They're clickbait, the explorers, because they start at pennies, they move a little bit, and they move 10,000%, and that's the clickbait. And it doesn't work. Look, people just look at the ASA. ASA has a nice range of explorers, producers with certain amount of ounces in the ground, JDX and all that stuff. There's no reason to get fancy. Royalty companies, like I look at a few charts, they're starting to turn up. You know, they got hit hard a lot there. I can't remember. I got an alert today for Metalla. It's starting to turn up, but practically that whole range of miners, as soon as you have a gold and silver label of a miner, when the capital flows start going to the sector, all those charts are practically going to look the same. So I'm not trying to time anything. Once the ASA chart peaks out versus the Russell, or the Russell bottoms out versus the ASA, and gold peaks out versus this, like from with the SPX and all that, they're probably all going to go down. Yeah, so people, yeah, could have fun with explorers, but if you're wrong with your explorers, you're not protected by a weighted approach, right? You really, it's a lot of effort, right? I know a lot of people do that. They have to pick a whole bunch, and hopefully you're, yeah, I don't know. I don't think you'll do that much better than the ASA, which way more simpler and also liquid, right? These penny stocks. Try to get out your position when somebody's dumping, and then it goes down. You get, like, I don't know. It's a whole mess. Like, I just rather I would just probably play just the major ones, and there's no reason to get fancy, right?
Yeah, that's all I do.
Yeah,
Simple, easy, follow
yeah,
the move. At it with
yeah,
a
yeah.
leveraged move.
Yes, exactly. Like, there's
Yep.
no. Yeah, we're not financial advisors. People could get their leverage anywhere they want, but people could buy options. They could get futures. You could own more gold than you have in your, like, you know, if you want to make more money, you don't have to buy one for one. Let's say you think gold's going to go in an uptrend. You don't have to take $100,000 and just buy $100,000 worth of gold. With $100,000, I know this is definitely not financial advice, but you, on margin, you could control $1 million worth of gold, right? So or people play options, whatever. There's leverage types of plays you could do to move up, to track a trend. So everybody's got to do their own risk and money management, and make sure they don't get destroyed by any single trade. But how do we go down this financial advice stuff, man? I'm super scared now.
Oh no, not financial advice. No, so when I always look at things, like there's a way, like let's say when I look back and how I've actually made money, it's identifying the correct trend, and you can identify the trend but completely blow it on choosing the vehicles to play the trend.
Yes.
So what a lot of retail investors do is they sit there, they're like, hey, this is the trend that's coming, and then they just completely blow it with the companies that they choose. They go like buy these like obscure exploration companies that no one hears of. They're like a 2 million market cap, and it's a complete scam that they heard from some YouTube channel that they had purchased or sold or whatever. You know, like they do some sort of advertising on a YouTube channel, and then they go and they buy it. But they had the move. It was all set up perfectly, just like we're talking about in all these different setups, and they completely blow it on the vehicle that they chose. So where I've made all my money is to get the trend right with the ratios and everything, but I also got the vehicles right to play it. Like you have to have both of those things. If you choose the wrong vehicle and you chose the right trend,
I know.
you were right, and then you just screwed yourself on the back end choosing the wrong vehicle to play it with.
That's a heartbreak. It's hard.
It is.
It's a heartbreak. It's a heartbreak. It's like, yes, it's because now 4 or 5 years moved on. You've missed it, and then you're. It's like the guy playing poker, and now he's on tilt, and then you pick even crappier mining companies. It's just, and you don't sleep at night. You can't tell your wife. You have a divorce. You lose the kids. It's terrible. Don't go there, guys. But you're right. It's so simple. Don't people get greedy? Don't get greedy. It's sad to say, but most of the new millionaires in the year, they started the year with 900,000 or 800,000 in their bank account. People get greedy every single time, and that's why people, they see Bitcoin, they're in love. they're living in the past with these people who made 10,000%, but those gains are from $1 to wherever it is today, you know? So you're right. Get the trend right. At least make sure you're going up. That's a win. And after that, you're right. There's stay with I like the liquid stuff, and yeah, people could have fun with options and whatnot, but at least play those things with the chart that has a confirmed uptrend, right? JDX is not going to go bankrupt. AS is not going to go bankrupt. Silver is never going to go bankrupt, you know? Like, just play silver for crying out loud, guys, instead of a miner. If you like leverage and stuff that goes bonkers, just like, there's silver. And even oil has a huge potential to go bonkers also. Yep. Uranium also. The Uray chart has huge potential. Oh man, Cameco, and there's dividend paying stocks. Like, everybody has something to decide, right? There's great oil plays with huge dividends. It's crazy what the setup we're at. Did you realize how much dividends are getting paid in the oil sector? It's like, in these crappy explorers, they have no dividends, guys. So oil, I looked at the Shell choice. Okay, check that out. I think it's Shell, or no, Barrick. Shell in the 80s. Shell, adjusted for dividends, was a rocket ship. A rocket ship, man. So every time, even if the price normally went down, they kept paying out dividends, and huge gains during a bear market, a wasteland for oil in the 80s. If you would have owned Shell Oil, you would have been like, sleep like a baby, man. Shell's not going to go bankrupt. You sleep like a baby and you make huge returns. It's stop it, guys, with these crappy explorers there. Yes, I know they will go up. The capital flows will go everywhere, but like you said there, they could go under at any moment. You don't know, and they're not even if they go up, they're not very liquid, these things, right? They're somebody drop. So
yeah, the way that I've made my money, at least, is to pile into things that work and that are going to actually follow that trend. It's you don't want to waste the opportunity. That's the way that I always looked at it.
And if these capital flows are defined on the higher time, like from these huge shifts, these big pension funds are moving the price before that money trickles down to those small explorers. They're going to go and stuff they're allowed to buy, right? They're only allowed to buy JDX, maybe. They're only allowed to buy ASA. So those are always going to, get those capital flows first, right? Mm-hmm. And your miner, well, yeah, I don't want to hit too much on miners, but those crappy miners, but there's some stuff in there, man. It's just bonkers.
Yeah, a lot of people think gold and silver, then they go straight to like companies, and a lot of the companies I think it's a hard sector to make a lot of money in, because there's so many companies that are subpar, I'll say. They're not making money. They're not cash flowing. So it's just a little bit more difficult sector. You have to really pick through it, in my opinion. Do you have anything else that you'd like to share, Patrick?
No, I think that's good there. It's a good recap of where the major asset classes are battling out. And that's the takeaway, right? Why nominally SPX and NASDAQ might grind higher, people have to look at those ratio charts to position themselves in the best performing assets.
Okay, and if somebody wanted to reach out to you, how do they contact you?
Twitter, BadCharts1, guys. All the free stuff's there. And if you like paying for stuff, then go on NorthstarBadcharts.com. But they're probably hooked up on your website already, so that's all good there. Good value everywhere.
Yes, good. All right. Well, that's all I've got. Thanks for coming on, Patrick. Appreciate it.
All right. It was an honor. Thanks, Andy.
Yep. Catch everyone next time.
Bye, man.